Good afternoon, everybody, and welcome to the latest Urban Living webinar. And today we are going to be taking a deep dive into investment in the living sector. My name's George Sell. I'm editor at International Hospitality Media, and we are a publisher of B2B news platforms for the real estate and hospitality markets. And we are also event organizers. Today's webinar is going to last an hour. We'd like to make it interactive, so if you have any questions for our panel, please do submit them using the Q&A or the chat functions in Zoom. And if you've registered for the session, we'll send you a link to a recording of it over the next couple of days. The Urban Living webinar series is sponsored by Abode Worldwide, and we're going to watch a quick video to find out some more about them. Thank you to Abode Worldwide for sponsoring. If you'd like to get in touch with them, you can see their contact details in the chat. And there's going to be quite a lot of information posted in the chat today. So when the session finishes at 3, we're going to leave it open for a couple of minutes just so you can take some notes. Just wanted to show a couple of quick slides to outline some of the investment activity that we're going to be talking about today and some of the sectors. So here you can see deals across the student housing space, later living, co-living. And again, on the next slide, some of the other sectors we're going to be talking about: build to rent, single family rental housing is particularly topical at the moment. There's a lot of interest there. And the investment we're talking about is ranging from institutional investment, private equity, and funding rounds, individual asset transactions, and so on. So there's quite a lot going on, even though the current economic situation is making things a little bit tricky. So we've got a great panel to talk about this today. I'm going to ask them to introduce themselves in turn, and we'll go from left to right as we see them on the graphic there. So Jamie, good afternoon to you. Do you want to introduce yourself and tell us a bit about what you do?
No, thank you so much, and great to join you today. But I'm Jamie Harris, Head of Student Accommodation at Harris Associates. And Harris Associates is a UK investment agency concentrated on student accommodation, co-living, BTR, and offices across multiple markets. Since our inception in 2002, we've done about 18 billion of transactions in the UK market and currently have about 2 billion of projects in the market at the moment of different stages. So anything from forward funding opportunities to existing portfolios of assets and land and everything in between. So looking forward to having a chat today.
Great. Thank you, Jamie. Martin, welcome to you.
Thank you. Thank you for having me here. My name is Martin Zdravkov. I'm a lead portfolio manager at DWS. DWS is the asset management arm of Deutsche Bank. My focus is on growing our pan-European living platform, which includes residential, student accommodation, and to a growing extent, co-living and senior living. We've been a significant player in the residential and the student accommodation space for over a decade, and one of the first kind of large institutional investors in a number of different European markets.
Thank you, Martin. And finally, Francesco, good afternoon to you.
Good afternoon. Thanks for having me today. I'm Francesco Zanella. I've been with Starwood Capital for the past 10 years, and I'm managing director, and I oversee our Southern European investment desk.
All right, thanks. Well, welcome to all of you. Thanks for joining us today. We've got a lot to talk about, so let's crack on. I want to start by asking you, excuse me, how investment strategies are adapting to the current economic headwinds, and whether short to medium term issues are affecting your investment strategies and activities. Martin, I'd like to kick off with you on that one, please, if I may.
Yeah, of course, absolutely. So we are custodians of insurance and pension capital from across the globe, and what we have seen is a significant shift in terms of the risk return profile of our capital partners. While 18 to 24 months ago, the living sector was effectively, well, the various different living sectors were effectively a source of cash on cash returns. Now, with the changing economic environment, they need to punch significantly above that historical cash on cash distribution yields. So the focus at the moment is very much clearly on total return over short-term investment horizons. So a typical investment that used to be focused on delivering kind of low, stable, predictable, arguably inflation correlated, if not inflation linked returns over a 10-year business plan is now total returns, squeezing as much leverage as you can from the current markets over a 3 to 7 year business plan.
Okay, so this has effectively made you a more opportunistic investor in the current environment.
Absolutely.
Yeah. Okay.
We just to put it very simply, we don't believe the valuations.
Yeah.
Which is why we have to be opportunistic.
Yeah. Yeah. Okay. Francesco, does that tally with what you're experiencing?
Yes, George, absolutely. I mean, definitely, we're in a world where the risk-free rate has changed dramatically, and that needs to have an impact on valuations. There's no other way to put it. It's almost mathematical. You cannot escape bond math, unfortunately. Well, there is one way to escape bond math, which is through explosive growth. And I think we're going to touch upon the topic later in the conversation. Recent rent regulations across the piece and questions about affordability are now probably one of the most important factors to be considered when investing in the sector, I would say.
Yeah. Okay. Thank you. And Jamie, your investor clients, have you noticed a change in tack? Are people pausing to draw breath to see where interest rates go, or is there still a significant amount of activity across the sectors?
Yeah, I think it's really interesting from our perspective because obviously we get to speak to capital at different styles of, IRR and cash on cash returns. And also through our relationship in Singapore with a group called Edmund Tai, we were out there just over 2.5 weeks ago. And I think, as Francesco and Martin have said, the market is challenging. I think, however, what we are finding is that there's liquidity around opportunities that are considered to be, prime locations or prime product. So maybe the more secondary or tertiary opportunities are really suffering from quite substantial yield expansion and lacking the liquidity there for institutional buyers. But those opportunities that are in the prime and super prime markets seem to continue to be attractive, certainly in the living spaces. So, for example, I noticed that someone on the call is from Hub, who's one of our clients who are doing a project in Edinburgh and we're finding that actually Edinburgh, continues to be an incredibly strong market, and that's just one example of, funds and investors looking at the best opportunities in the market at the moment and being super selective.
Yeah. Thanks, Jamie. So we're talking about quite a wide variety of asset classes today. We're talking about PBSA, build to rent, later living, co-living, and to an extent, I think you can include the flex workspace offer in that. Martin, which of those do you currently think is the most attractive with investors, and why?
That's a great question, George. I wonder if I should actually give you a politician answer or a kind of honest answer.
No, give us an honest answer.
I'm going to give an honest answer. PBSA. I think the student sector is absolutely, from my perspective and from our perspective, the most attractive one. It is, the way we think about it is kind of the living sector on steroids, without the interference, without as much interference from politicians as the overall residential sector is. And the reason being is kind of multiple folds. It's kind of leaning on demographic trends, leaning on kind of the knowledge economies, leading on the undersupply of that sector, leading on the nascency of that sector in many European countries. Now, clearly UK is further ahead. However, some of the other markets are, it's really kind of an HMO style from a UK kind of perspective. Also, let's be honest, teaching effectively economics in English, you can do that from just about anywhere in the world. I mean, it's a high margin business for many universities. So effectively, it's an easy way for them to attract students, and most of the students from kind of international background tend to be attracted to economics, accounting, subjects that are kind of fairly kind of high margin for the universities themselves. Now, if I have to rank, the second one would be residential, and then within the residential, probably a little bit leaning towards the single family over the multifamily. Then later living, it would be third, and the reason why I would put later living third is just because of the nascency of the sector. I mean, it's still very much underdeveloped, and you're kind of having to take a decent amount of risk around the overall product. And co-living, the reason why I put co-living last is not because I think there is something fundamentally wrong with it. On the contrary, I think it's a very viable housing solution in kind of affordability constrained and space constrained cities. However, my personal question kind of for all the co-living operators and managers is, what it's not very clear what exactly is co-living in terms of the use class. And I think it's most of the co-living schemes that I have seen have been one form of kind of repositioning of existing office buildings or existing hotels, but ultimately from a kind of like resilient capital, what exactly would we be investing in? Is it the kind of, in a UK context, a C1 residential planning permission, or is it a C2 general, correctly, hotel planning permission? And until that one gets more clarity, I think you will see the more core plus capital sitting on the sidelines of co-living.
Yeah, obviously, and as you say, you know, the answer to that question varies from region to region, from city to city, and then, you know, in London from borough to borough. But it's starting to take shape. Thanks, Martin. That was interesting to hear your list in order of ranking there. Francesco, would you place them in a similar order, or are you going to contradict Martin?
Oh, no, absolutely. I would never contradict Martin, George.
You can if you want.
I think it was spot on to an extent. I'd probably, stress a couple of things. Definitely PBSA is number one. And going back to what I said at the beginning, it's because you can grow, like cash flow can grow in PBSA. And yes, I agree that PBSA to an extent is residential on steroids, but it also follows something that also Martin touched upon, different dynamics, like investment in education. It doesn't really matter whether it is affordable to pay students housing rents for a lifetime. You're only going to be there for a couple of years. So 1 year or 3 years or 4 years, depending on where you're going. It's more a factor of how much you're willing to spend on your education. And we know that that is a budget that is not shrinking. That most families are deciding to invest more in the education of their kids. And so that trend, I think, is quite a potent one and a predictable one. There are some clouds at the horizon, of course, what's going on with China, whether we are going to still get that many students from overseas in European universities is a question mark. But I think, as Martin mentioned, the asset class is so undersupplied that there's plenty of room to absorb a demand shock and keep rents growing at a steady state for the foreseeable future. Residential, certainly, whether it's multi, single, is a tiny bit more cloudy. As I mentioned earlier, regulations and affordability are two great concerns. And now I'm talking mostly about European residential. George, I don't know if there are people that are listening to us from across the pond, but in the US, you've had strong inflation, strong rate growth, but you also had strong wage growth, tremendous wage growth. So in fact, the affordability of the housing stock in the US has remained kind of in line to where it was in 2020, around 25, 28%. That's not the case in Europe. We've had tremendous rental growth, which has not been met by a matching increase in wages. And that has posed a problem, of course, to politicians. The answer has been almost across the piece, regulations. And as I've already told you once, George, one thing the regulations always achieves is making things more expensive because it increases frictional costs. And that's what we're going to see, unfortunately. Still, you know, PRS residential remains the largest and most liquid asset class in the real estate world, by far, by a factor of 10 probably. And it answers a very primeval necessity of everybody, right? One of the few things that, you know, both myself and a hedgehog have in common. We want to sleep in a dry place. So again, it is very defensive, but we need to see that growth because the risk-free rate has moved from 0 to 4 or 5%. That is infinite increase, right? Because we start from 0. We need to find a way to find that growth or to reduce our cost of capital in the residential sector. And the last thing I want to mention is co-living. I totally agree with Martin. Co-living right now is a big bucket in which you have a ton of things in it. You have very prime, luxurious, quirky, funky products on one end. That bit, I totally agree with Martin, is third or even fourth in this list. But there is another type of co-living, which is effectively affordable student housing, which is affordable residential. That sector itself is effectively plugging the gap between a heavily regulated and therefore very expensive to enter residential sector and the necessity of people of living somewhere and being able and willing to give up on space in exchange for affordability. That bit, which is becoming more and more, again, a replacement for affordable housing in countries like Spain, a country like Italy, or it's more a replacement for student housing or affordable student housing. That trend, I think, is one that is extremely attractive as it unlocks that potential growth, leveraging on affordability and finding efficiencies in the sector and potentially leaning on technology.
Yeah. Thanks, Francesco. Jamie, this must be music to your ears. Student housing is top of the pops for both of our investors here. Can you give us a bit of context as to why the fundamentals for student housing are so strong? I mean, we've had things like private landlords, HMO landlords leaving in droves, an increase in the number of university courses and students, but you know, all strata of the living sector has got great fundamentals and when it comes to supply and demand, but student particularly so. Can you kind of give us a background to the situation that you're operating in?
Yeah, no, sure. And I think absolutely echo what Francesco and Martin have said with regard to the resilience and counter-cyclical nature of the student housing marketplace, because you know, what you usually find in student accommodation is that in times of economic uncertainty, you have more students going to university, looking to upskill and maybe staying at university in order to avoid going into the jobs market. What we are finding right now is that there's been a 75% reduction in planning applications in the student housing sector, while the demand for studying and higher education in the UK continues to increase. And I think by 2035, there's going to be another 400,000 additional students studying in the UK, partly because of the demographics that we're finding. So we're coming out of a sort of demographic dip and entering a 10-year period where there's going to be year-on-year growth in number of students going to university. And we know that because we know that the number of 18-year-olds coming through is more and more every year for the next 10 years. And I think even now we're reaching a situation in some of the key markets throughout the UK. And I know, Europe is obviously even more nascent and even harder to get student accommodation, but places like Manchester, for instance, where the university was actually paying students £2,500 to stay in nearby cities like Huddersfield and Liverpool, locations like Durham, where you had queues of people around the corner looking to take on accommodation, any accommodation fine, where there was kind of dormitories of students staying collectively in buildings. So, we are reaching a circumstance where there's very limited supply coming through, but actually the demand continues to increase. And I think to Francesco's point about what that looks like and uncertainty around China, I think that's something that a lot of people are thinking about right now. But what we are finding this year is that we've had a slight leveling off or reduction in Chinese students, but an increase in Indian students and African students as well. So that's a key trend that I think we'll kind of see over the next few years, as maybe a slight rebalance of what that international cohort looks like in the UK. But I think what is really clear is that the UK as a student housing destination, and certainly some of the European markets as student housing destinations keep becoming more and more pop. I think, the fact you can have income that year and you're able to increase that income is very attractive all at the same time every September. The fact that you have a specific demographic that you're catering towards is obviously very attractive as well. And certainly in the UK market, where your loan or maintenance loan is supported by the government, which typically does go up every year with inflation, helps support the growth in rents in this housing sector. So hopefully that's an overview of where we are right now. But I think invest to look at how they can meaningfully deploy capital.
Yeah. And in addition to the factors you mentioned, we've also had universities paying students to defer to future years because there's nowhere for them to go. Jamie, do you think the 75% reduction in planning applications is a temporary sort of short-term measure while people keep a watching brief on interest rates? And do you think if interest rates stabilize, maybe even come down a little bit, that number will go back to more or less what it was before?
I think predominantly it's a factor of construction costs more than anything.
Okay.
I mean, clearly debt, a huge prohibitive cost for new development opportunities, but the fact that construction costs have gone up by close to, say, 40% over the past half has been pretty damaging to many new planning applications, and also making new developments in cities where you have lower rent rolls almost impossible. So fields, the sort of Liverpool world, are just harder to build in. So I think it will take a few years of digestion and rental growth to then get to a point where those cities become viable to build in again. And therefore that opportunity for investors to benefit from that maybe 5 years of rental uplift on stabilized assets or assets that are already in the development pipeline.
Mm-hmm. It's Martin, it's interesting that Jamie's answer there, because I read a story about a house builder last week who was enforcing a 10% cut on material suppliers and subcontractors, because they reckon building is getting cheaper. Are you seeing any evidence that the cost of development in general is starting to stabilize or come down? I'm sure it's different across different areas of real estate, and maybe house building is different from large scale PBSA and so on.
I think you can probably gather from my facial expression is that you can read probably quite a lot of things these days. We're not seeing any of the any of kind of such trends, to be completely frank. So it has become virtually impossible to get a fixed price build contract over the past couple of years because of how things have done, which obviously has had implications on how things are being forward funded and who can actually step into the forward funding shoes. I can clearly see a situation where builders are, so we have to kind of speak when we speak about builders and we're going to speak about building contracts, we have to be able to differentiate between the corporate and the actual single project. So the corporates are much better capitalized than they were before, so they can withstand shocks. At the same time, single projects may not necessarily be as much insulated. So I think you can clearly see on single projects where what we have seen is anywhere between 10 to 25% discounts on asking prices in the residential space. I tend to subscribe to a kind of a more efficient markets theory of the world. So I can tell you that it's this one is the asking price, but really I would transact at 20% below. That effectively means that the asking price is wrong to begin with. So I can clearly see a situation where effectively house builders, predominantly in the UK, they're having to keep effectively their supply chain pipelines actually going. So for them, being able to take some sort of a discount on a number of the last remaining units in order to be able to ensure the supply chain keeps going and they're able to deliver the next project would be a viable solution. Yeah, you can transpose that to the continent, where in Germany we're seeing a number of developers actually going bankrupt, and that's a completely different situation. We haven't seen that as much in the UK context. What we have seen is a market slowdown of forward fundings. And I think forward funding transactions in the living space are still going to be challenging over the next 12, 18 months.
Yeah. Thanks, Martin. The house builder in question is called Vistry, if anyone wants to look at it. And the chief executive came out with a line that something like, the suppliers have had it for so good for so long, I'm not going to start feeling sorry for them. It was quite an abrasive comment, but anyway. Francesco, let's talk a bit about the lending and the development finance landscape. Do lenders have an appetite for the living sector in general at the moment, and are the terms they're offering realistic to get new projects off the ground, or is everybody waiting and see what happens with interest rates?
Thanks for the easy question. I am not a lender, so I see this from the outside. I would say, generally speaking, if there is some pocket of liquidity in the development space for construction financing, that would be in the living sector. And we've seen banks pulling back in a number of sectors. Residential remains at the very top of the priorities, I would say, of the pecking order for most lenders, and that includes private credit. A lot of money is currently being raised in that sector, and so it's not just conventional lenders, but it's also specialty lenders and again private lenders that are active in the sector, especially in the development in the development stage. This said, again, and I know I'm repeating myself, but when the risk-free rate goes from 0 to 4 or 5, that means that development financing, the cost of development financing has effectively doubled or tripled in certain instances. And that has an impact on the final economics of the transaction. Again, construction costs increase by 20, 30, 40, 50, 60, 70%, depending on the asset class and the country in Europe. Financing has become twice as expensive, and the cost of equity has increased too as a result. And that means that in order to make development stack up, economics need to be way more compelling than they used to. And that is a bit of the problem that we're seeing that will eventually curb supply of residential product. And it's my main concern when it comes to affordability, that, as you know, is one of my first concerns, generally speaking. And the only way to cure it is to develop more. And it doesn't look like we're going in that direction.
No, it certainly doesn't. Jamie, we mentioned earlier the project in Leith that you're working on, for which you're currently seeking a forward funding partner. Is forward funding the kind of go-to model at the moment for getting large-scale developments off the ground?
I think, as Martin, forward funding is obviously trickier than it was 18 months ago. And I think what has been more in vogue at the moment is the sort of joint venture structure between large institutional funds or US private equity funds and developers. The funds feel like the developer is taking that kind of risk alongside them and then back-ending some of that profit. I think developers do feel right now that, if they believe in the locations that they've got, then it could be a risk worth taking, because ultimately, we all know that in the right locations, rents will rise, and the likelihood is that in 3 years' time, once these things are built and stabilized, that yields may have come back down again, or certainly have stabilized. That being said, for the very best products, like this particular opportunity called Shore Station in Edinburgh, where you've got 632 beds and a very institutional developer and a location where the last 5 planning consents have been rejected, it becomes, I suppose, a lot more appealing to just do a forward funding and make sure that that's a kind of clean structure. So I think it's very specific to the project. If the project is strong enough and is in the right location and with the right developer, then it could have, of getting forward funded. But as a market, Martin's absolutely right in saying that the joint venture approach, more kind of programmatic, entrepreneurial, creative, even structured solutions and debt solutions that I know some of the funds are doing right now, seem to be a bit more popular.
Yeah, thank you, Jamie. I was at an event this morning which we hosted for the hotel sector, and one of the sessions was about sustainability and how you measure that. And there were some really eye-opening statements about the kind of roadmap that we're on to 2050 and what the built environment as a whole has to do to get to where the government has decreed that we need to be by 2050. I'm interested to know what impact the ESG agenda is having on investment strategies at the moment and how you think that will evolve. Martin, would you like to kick off with that one?
I guess after Francesco got the last easy one, it's over to me to get the next easy one. It's making it significantly more challenging, both from a development and from an operational perspective, the ESG requirements. What will end up happen, and we are already seeing that, is so one of the funds that I manage has a hotel asset in our German, top 6 German city location, where the replacement cost of the asset, because of the ESG requirements, were to burn down and has to be rebuilt, is actually higher than the investment cost of the asset. The investment valuation. So I think you will end up seeing that coming through. And in the living sector is actually really tricky. It's really tricky to implement, for example, ESG requirements in the residential. Because how do you tell the underlying occupier that they have to change what they do? Like, it's an invasion of privacy. And I think this one will kind of start coming out over the kind of coming few years. Probably not as little as 5, but definitely not as much as 20. So it will have to be very carefully curated response. From what we're doing is what we are kind of very heavily focused at the moment on energy efficiency, on kind of building embodied carbon, and on EPCs as a kind of a measure of that.
Mm. And is that because the capital that you are working for, I mean, pension funds, for example, I would have thought have a fairly lengthy ESG tick list about where you can invest their money. Is that being driven by them or by you as an investor, or
both? Okay. Both. We recognize that we as a corporate, as an investment manager, have a responsibility to answer some of these calls, but then equally the capital partners that we have are demanding some of the answers. I know Francesco has a question, I think, or a comment.
Yeah, Francesco, over to you.
I just wanted to comment that I totally aligned with what Martin said. I think it's fascinating. Like, if you rewinded the clock to like 1.5 years ago, we would be sitting here saying, oh, ESG is the best thing ever. We need to invest more in energy efficiency across the piece because tenants in the office space, in the industrial space, in the residential space are willing to pay for it. And now I think, what I'm hearing is becoming a bit less straightforward, right? When investment returns, target returns increase, it becomes more difficult to justify, investing in something that doesn't have an immediate return. I think there are two types of ESG investing, and we spent a lot of, again, with money where, costing zero, we spent a lot of time in just doing, anything we could. And there was a lot of window dressing, and there was a lot of the kind of group thinking. There is a second type, which I think we haven't spent enough time on, which is positive sum ESG investing. And that's, I think, what we all have to do going forward, and generates incredible value. For example, we're investing in solar panels intensively at the moment, in conjunction with our industrial investment. And that is something that it's a win-win-win. Of course, we generate clean energy. We reduce the energy bill of our tenants, and so they're happy, and we maximize our returns because these tenants are paying for energy, and the yield on cost currently on energy is pretty attractive. I think we haven't done enough of that kind of positive sum game, and we've done a lot of the window dressing, or a bit too much of the window dressing.
Yeah. Okay. Thanks, Francesco. I'd like to move on for a minute and talk about planning and the impact that has on investment in the living sector. We've already touched upon co-living, where there isn't really a coherent attitude from the planners to the nascent asset class. But it strikes me that we have such a shortfall of supply across student, across build to rent, and later living. But it's not something that planners are stipulating in local plans, which I find surprising. Do you think a more enlightened approach to these various strands of the living sector would encourage more investment? Jamie, do you want to pick up on that one first?
Yeah, sure. No, thanks for that point. And I think planning.
Everyone's getting a hot potato today. Don't worry.
Planning's a tricky one, isn't it? But I think it's worth picking up that thread on co-living, because we've actually got a co-living report which we're bringing out on November the 1st. And what that has kind of shown is that the residents actually love being there, and the community is actually one of the top two reasons why they're there alongside affordability. So, you know, I think what Francesco was saying earlier is that it could plug a real gap in the stack of residential between, you know, BTR and just general PRS provision. And co-living does seem to be one of those key sectors where people don't really understand what it's all about, and therefore planning makes it increasingly difficult. But I think we're getting there now with a movement possibly away from the C1 type consent and towards the more sui generis residential style use class. And so I think as more schemes open, like Folk and ARC and various others in London, and obviously we're all learning from Europe, because ultimately Europe is much more at the forefront of the co-living sector than the UK right now, then the planners, I think, do get much better understanding, especially when they're able to walk through. So I think the answer to your question in a sort of short fashion is that there's room for growth. And I think there's a lot of our developer clients now that are looking at more mixed use neighborhood style opportunities where they're building BTR next to student housing, next to co-living, next to later living, and they're creating kind of broader communities on, you know, vast swathes of regeneration city centre brownfield land. And I think that's where the planners can sort of get behind some of these emerging use classes a bit better, because they can see that it's part of a broader strategy and broader community. So, you know, we've seen the likes of Vita and Moda and various others taking that sort of approach where they're saying, look, we would rather do a 5-acre site and put different use classes on there than do just a standalone block. But planning is certainly a stumbling ground, and hopefully will be addressed as we kind of move forward next year. And I know that obviously it's always a hot topic of conversation with the government.
Yeah, I mean, we had an event the other day, and one of the comments that I made was, I think that since this government came into power in 2010, I think, so 13 years ago, we've had 15 housing ministers. So, you know, that gives you some idea of how much attention they actually give this issue. Martin, I can see you've got your hand raised. You want to come in on the planning topic?
Yeah, I think I was just going to say on the planning topic, it's I haven't come across anyone who has said that the planning is fit for purpose, let alone good. And then in terms of the housing ministers, the joke that I heard was that if you know the name of the current housing minister, you are the current housing minister. So I think planning is just one of these things, and in itself it's super complicated. And I think I was having a conversation with a colleague and a peer who said that effectively for every 20 fundings or kind of like capital sources that you have for forward funding, for a JV partnership, for a stabilized asset, whatever it is, you have one capital source that's going to take planning risk.
Wow. Okay.
So that in itself shows you the capital is just not there to fund the planning risk.
Yeah. I mean, it is a complicated situation, but the case to demonstrate the need for more rental housing, more senior living housing, and this kind of stuff, that isn't complicated. So why that can't be factored into planning policy, I don't know. But
because ultimately planning is in the UK is a negotiated game. That's it. Simple as that. You have broad brush principles, but it's a negotiated game.
Yeah.
And I think that uncertainty, whether you're gonna find a recipient planning officer on the right side of the bed in the morning, it's just too much of a risk with a binary outcome.
Yeah, and it's a vote winner or a vote loser in certain key areas as well. So anyway, let's move on from planning. So what sort of deals can we expect to see across the living sector in 2024? Do you think we'll see a significant number of assets changing hands? Do you think we'll see operating platforms changing hands or portfolios? Francesco, would you like to kick off on that one?
It's another good one. Look, I think investment volumes will reduce, and they've already reduced and would probably stay at this level or fall further. I think the market operators are coming to the realization that the current rate environment is not that exceptional, right? It's probably the last 10 years have been exceptional. And although we've all, grown accustomed to the leveraged deal play, and we've all drunk a lot of our own Kool-Aid to a certain extent, but it could be said that going forward rates will remain elevated, and that means a potential adjustment in values if we're not seeing growth. And probably next year it's a bit too early to see the first seeds of future growth. But in terms of what I see as most investable at the moment, it's certainly PBSA platforms. The entire platform universe is quite compelling. It is cash flow generating and it is asset light, and benefits from the same trends that we're seeing in the kind of asset heavy sector, but of course requires less capital and less financing, and it's less dependent on bank financing especially. So certainly anything that is operational, especially in the PBSA sector, would be at the very top of my list. If it's asset light, probably even more likely to happen. And again, there will be liquidity. PRS residential sector, I believe, will remain one of the most liquid sector in Europe, regardless of the fact that potentially risk-free rates might edge a bit above cap rates in the sector, but certainly expect the volumes to stay muted until we're going to see growth coming back to the market.
Thanks, Francesco, and thank you for actually answering the question that one of our attendees has posted there, which says, "Do you invest in property managers or purely in real estate?" So you obviously like the
definitely, we love property managers.
Yeah, so you've answered that one. Jamie, you've got your hand up. Tell us about what kind of deals you're expecting over the next year or so.
Yeah, I mean, look, I think what Francesco said is pretty bang on, to be honest. I mean, ultimately, a lot of the capital is attracted to the student housing sector predominantly because it is one of those sectors in living that always represents a stepping stone, and one that you can get institutional scale of 300, 500, 600 million portfolios built and in good quality in reasonable sort of quick succession, whereas the likes of the BTR sector, which is equally as compelling in the UK, just doesn't have that same scale and track record as student housing. So, for example, we sold an asset earlier in the year on behalf of a developer to Blackstone up in Nottingham, and we just did a JV with a developer in Leeds to BlackRock. And I think the general thesis or ethos that a lot of the investors are talking about right now is how can we really build scale in the prime Russell Group cities, in the best quality assets, in the best product. And I think, as with any sector in challenging times, there's always a movement to core and a movement to product that people can truly stand behind and get behind their IC. So, we have seen, for example, the Vita deal happening with Savills IM and EPF, who are a Malaysian sovereign wealth fund. We've seen Harbert coming in for the Skyfall portfolio, which obviously Francesco, I'm sure, will know well, and also various other projects that are bubbling away at the surface with Blackstone and others in the UK market. So I think that those projects of true quality or projects that have strong operators or developers attached to them will do incredibly well. Those projects that are more secondary or were possibly purchased on the basis of doing some form of value add refurb or delivering a slightly subpar product but is looking for that affordability gap may not do quite as well because they don't have the ESG boxes ticked, nor do they have the fire regulation boxes ticked with a double stair core. which is clearly quite a big issue right now. So I think those people that maybe, especially the private equity funds, were attracted by buying very basic, very kind of first generation type formats, and now thinking to themselves, actually, we don't really want the headache of that. We'd rather just buy an existing portfolio where the yields are actually quite compelling now and benefit from, maybe a 7% yield on cost, whereas before it would have been a 5.5% yield on cost.
Yeah, thank you, Jamie. Martin, one of the things we've seen in the build to rent space was the introduction of a rental rise cap in Scotland, which put the fear into a lot of investors, and quite a few drew back from that. And we've got the spectre of that, perhaps if a Labour government comes in here. How do you think that's going to affect investment in the build to rent sector?
I think you're being very kind, George, to say some investors withdrew from Scotland. All of investors withdrew from Scotland. I think let's call a spade a spade. Like, nobody actually put a spade in the ground, funnily enough, pun intended, on the back of the rental cap in Scotland. And I think they are realizing that this is happening, and this is actually an issue. I think we have to kind of differentiate between rent caps and rent regulation. And I think these are two very, very distinct issues. Most investors are happy with rent regulation. Take a look at Germany, take a look at Holland, take a look at Sweden. These are all heavily regulated markets, but they're not starved of investors. Now, having a completely random kind of devotion from reality rent cap of whatever it might be, 0 in Scotland, 2 in Ireland, does not help anyone. Back to Francesco's point, like we are suffering from an affordability and supply crisis at the moment across Europe, across the living space. I challenge any politician to actually demonstrate that putting a rent cap, a completely randomly picked a rent cap, is going to address the supply side.
Interesting.
So I'm going to stop there.
Martin, I totally agree with you, by the way, 100%. I think it even destroys the demand side, because a rent cap, like, what happens is it benefits people that already can afford where they live. In an environment where rates are where they are, people are not buying, are staying where they are. It reduces the velocity, the turnover of tenants in the little residential product that we have. And we end up with people that couldn't afford a place where to stay before, and they still can't afford, and they cannot even find it. So you're creating a real social issue, I think.
We're going to move on to a couple of questions from attendees. One's just come in here from Asil Haddad. Thanks, Asil, for your question. This is an interesting one and very topical, actually. Today, a motion has moved forward to increase planning permissions by 35% for major application fees. Brackets, not yet passed by Parliament, but likely. How will this impact development? So I'm going to ask who wants to kick off on that one, as it's very of the moment.
I think as Martin said earlier, if there's more clarity around the planning application process and people actually can have a fast-tracked process with clear guidelines and an understanding of what can actually be achieved, I'm sure people would pay double the price, let alone 35% more. So I think if that regulation comes with additional fast-tracking and additional personnel and ability for developers to get much more understanding of what they can actually get hold of earlier in the process, then for sure they would pay more. But if it's just that it's more for nothing, then it's of course always challenging.
The other question, I guess, is will it get through Parliament in time before the next election? This is the other interesting one. Martin, do you have a view on that?
Development. I'm going to try and paraphrase Milton Friedman here. Development is always and always a political game. So he said, when he said that inflation is always and always a monetary policy challenge. So development is always and always a political game. I completely agree with what Jamie is saying in the sense that they're like, if I haven't come across that one, and thank you very much for highlighting it. If that's true, that's fantastic, but it has to come like paying more for getting the same. It's not a winning proposition.
Unless you're a budget airline, but anyway, another market altogether. Gentlemen, thank you. That was a really interesting conversation. We've pretty much come to the end of the session. I just want to show a couple of quick slides before we wrap up for the day. The next Urban Living webinar is next week, and we're looking specifically at alternative real estate and operational real estate in the MEA market. The link to register for that is in the chat. If you'd like to work with us across any of our digital platforms or our face-to-face events, please get in touch with my colleague Henry, whose contact details are on the screen and also in the chat. I should have mentioned earlier that the LinkedIn profiles of all our speakers today are also in the chat. So if you want to carry on the conversation with them, then have a look in there. And as I mentioned earlier, we're going to keep the session open for a couple of minutes now, so you can take some notes from the chat. That just leaves time to say thanks again to Abode Worldwide for sponsoring. Thanks to Jamie, to Martin, and to Francesco for their great contributions today. Thank you to you all for watching, and enjoy the rest of your day. Thanks very much.